Hello, I'm Ian Stewart, Chair of the Board of Leithner Company. Today's presentation is the latest in a number of presentations provided to current and potential co-investors of Leithner Company. It contains information about the performance of Leithner Company, but also of contemporary issues impacting our operations. Today's presentation will be provided by our co-managing directors, Dr. Chris Leithner and Mr. David Guy, and facilitated by my fellow director, Mr. Chris Satsopoulos. So over to you, Chris.
Thanks, Ian, and welcome everyone. Before proceeding with the presentation, please take a moment to pause and read the disclaimer. In this update, we're going to cover 4 key areas. First, Chris will go through our current portfolio holdings and cover the 4 changes that have been made in the March quarter. Then David will summarise the result of a deep dive into the company's monthly results from January 2020. Then David will compare these results with our major benchmark, the All Ordinaries Total Return Index. And finally, I'll review how prospective investors can become shareholders in Leithner Company. Chris, over to you to talk about our top 10 holdings.
Thank you, Chris. Since 1999, we've typically held a relatively small number of equity investments, usually in the range of 12 to 15. On the 31st of March, we were part owners of 17 companies. Given our very heavy weighting to cash, which was 36% of assets at the end of March and is now well above 40%, each of the companies we hold usually comprises somewhere between 4% and 6% of assets. Moreover, we typically hold each investment more than 5 years. As a result, from one 6-month period to the next, our portfolio churns hardly at all. Despite their many superficial differences, the companies in our portfolio usually share 4 fundamental similarities. First, they're well-established and lead their respective industries. Secondly, they provide essential goods and services. Third, they reliably generate profits and pay dividends. And finally, they possess the financial strength and managerial depth to address various headwinds, cyclical and possibly structural, and stresses and strains, and are able to maintain strengths and pursue opportunities. Let's go to the next slide. During the January to June quarter, we sold one of our holdings, sold a call option over another, and added to 2 of our positions. First, we sold our holding of Sigma Healthcare Limited. Over the last several years, Sigma's developed a state-of-the-art and thus low-cost network of distribution centers around the country. On that basis, it regained a contract which it had lost a few years back to supply Chemist Warehouse. And partly on that basis, late last year, Chemist Warehouse and Sigma announced their intention to merge. Sigma's contract with Chemist Warehouse necessitated a rights issue. We received our full allocation of shares and also all of the additional shares for which we applied. The proposed merger, which we think is a polite way to describe Chemist Warehouse's takeover of Sigma, caused the price of Sigma shares to zoom. They rose from about 70 cents before the announcement to $1.32.5 when we sold the last of our shares. We sold at prices between $1.27.5 and $1.32.5. A considerable amount of research underpinned our purchase of Sigma shares. In the same way, detailed research preceded our decision to sell these shares. I've always been bemused by the commonplace assertion that the decision to sell is somehow much harder than the decision to buy. From our point of view, each decision is simply one side of the valuation coin. At any rate, if our reasoning is valid and our assumptions are roughly accurate, then at prices above $1.30 per share, during the next 5 years, Sigma shares, including dividends, will return less than 5% a year. In other words, less than many term deposits. We admire the founders of Chemist Warehouse, and we reckon that the odds of its takeover of Sigma are better than 50-50, but well short of 100%. At prices above $1.30 or so per Sigma share, everything has to go right. Having purchased them from pessimists earlier this year, we were happy to sell them to optimists. The same basic story in broad outline applies to Goodman Group. A couple of years ago, for reasons we couldn't fathom, most people were skeptical or even pessimistic about it. We therefore wrote a large number of put options over its shares. Most of these options didn't execute, but some did. As a result, we purchased them at an average price of about $18.80 per share. Including the premiums we received from the options that expired, we bought them at the equivalent price of just $11 per share. Roll the clock forward to the beginning of this year, and the picture was diametrically different. In the January to June quarter, Goodman shares were selling well above $30. In fact, late in March, they approached $34. There's another parallel here with Sigma. A considerable amount of research underpinned our purchase of Goodman shares, as it does all of our purchases. Detailed research also preceded our decision to write call options over these shares. If our reasoning is accurate, then at prices above $32, which is the sum of its market price, the strike price of the options, and the premiums we received from them, during the next 5 years, Goodman shares, including the distributions, will return less than 5% a year. Again, that's less than most term deposits. Having purchased Goodman shares from pessimists a couple of years ago, earlier this year, we were happy, well, in principle, by writing the put options, the call option, beg your pardon, we're happy to sell them to optimists. Okay, third change, let's turn now to Elders. In the January-June half of 2023, and as we discussed in a video last year, we began to accumulate shares of Elders Limited. It and Nutrien of Canada are the oligopolists of the Australian agricultural and pastoral supply industries. That's one of Elders' attractions. Another is its capital-light balance sheet, an attribute it shares with Sigma. The breadth, depth, and geographical scope of Elders' operations tamps the volatility of its results, but they hardly eliminate them. On the 8th of April, in an update of its trading during the first half of its financial year, Elders in effect downgraded its expectation of earnings. These revised results remain solid, but no matter, its shares plunged something like 20% on that day. Having extensively researched its operations and prospects, this downgrade neither particularly surprised nor unduly concerned us. Given our research, it was evident to us that the market had overreacted, and therefore we bought more shares. Since then, Elders has retraced a decent amount of its plunge, and we're able to lower our average purchase price. Having first bought from pessimists a year ago, we were happy to add to our holdings during the one-day panic of almost a month ago. Okay, last but not least, there's Woodside Energy. Also, in the January-June half of 2023, and as we discussed in a video last year, we began to write puts over Woodside, and these contracts began to execute. Since then, we've written more options, most of which have executed and have thereby increased our holding. On the 31st of March, including the premiums we've received along the way, we've paid an average price of approximately $29 for these shares. That price, our comprehensive research tells us, given the quality of its assets and the longevity of its asset base, is quite attractive. Woodside possesses global scale. It ranks among the world's top 15 producers of liquefied natural gas. It also has a long history. It pioneered Australia's LNG industry, and it's operated the Northwest Shelf project, one of the largest projects in Australian history since the 1980s. It also possesses a long history of profitability, and we think its future's bright. The Northwest Shelf project has reserves and environmental clearances to 2070. That's 50 years into the future. And in an energy-hungry world, the consumption of LNG is going to rise for decades to come. As we've done for a quarter century, we're buying from pessimists. If past is prologue, then at some point in the future, we'll sell Woodside to optimists. In the meantime, we'll collect a steady stream of dividends. Okay, over to David.
Thanks, Chris. So what we're going to do here, it's a bit of a dog's breakfast of a screen, but since January 2020, we've been providing monthly net tangible asset backing for our company's redeemable preference shares. So this compares the monthly performance month on month for those 50 periods, so a bit over 4 years. Top line's our results, the bottom line is the All Ords for each year. So 2020, 2021, 22, 23, 24. Right, so breaking down those 50 periods, our results were positive for 35 periods. The All Ordinaries Index was positive for 33. So not too much difference there. We were more consistent. We were positive for more months than the All Ords, but not massively. The opposite numbers also apply. So we were negative for 30%, 15 times. The All Ords was negative for 34% or 17 times. But when we start looking across to the third column there, the average total return per month, we get to the real nuts and bolts of why our performance is so consistent. In positive months, we provided an average return of 1.6%. In negative months, a negative return of 1.3%. So that's good. We make more money in rising markets, and we have more rising months than falling months. So add those two things together, and it's a strong recipe for consistency. If you look at the All Ordinaries, their positive months are a lot higher, 3.4%. So they have a lot bigger booms when they boom, but similarly, their negative months, an average of 4.5%. So much bigger falls. And then if we go to the last column, it's an interesting one, and one I think is important, particularly for people's psychology, and that's the largest drawdown. So over that period, what's the most we'd fallen, and what was the most the All Ords had fallen in a consecutive period? And if you have a look at us, it was minus 8.2%. That was the March 2020 when we had COVID first hitting financial markets. Over that same period, the All Ords was off 27%. So that's considerable less mental stress on our shareholders as compared to just general market investors. If we go back one slide, that'll give us an overview. So even though we are less boomy than everyone else, over that 50-month period, we have provided a slightly higher overall total return than the market. So I think from our perspective, it's comforting that we do provide more consistency, a more conservative return, but we're still providing returns that are at or above what the market overall is producing.
Thanks, David. I guess to summarize, the portfolio continues to get the results that we've known over the last 25 years. We're currently cashed up with over 40% in cash and eager to buy from pessimists if the opportunities arise. The current net tangible assets is $1.028 per redeemable preference share as at 31 March. The current market capitalization of 30.5 million, and just a reminder, the intention is to soft close at $100 million. For those who are not yet investors, if you want further information, please reach out to either of the joint managing directors. As we like to say, our shareholders are neither clients nor customers, they're partners and fellow investors, and we pride ourselves on being personally available. If you'd like to talk to Chris or David on the phone or to arrange a Zoom, please let us know and we'll arrange a suitable contact. And with that, thank you for joining us.